All right, welcome to this video. My name is Taylor Bentood, and we're going to talk about cash versus accrual-based accounting and whether or not you should use cash or accrual for your agency. Now, this is an extremely important topic. I've pretty much seen no videos about it or anybody ever talk about it, especially for the agency model. And it's an interesting conversation. I'm going to tell you right now off the bat, this is extremely important for you if you want to forecast your cash flow, if you want to better understand and the health of your business, and if you want to keep a better pulse on your company. This is going to be a really interesting video that'll walk you through how to do those things. So, first of all, I'm going to tell you that one is not better than the other, okay? Now, I'm going to focus on the core difference. There's a lot of other differences that we could go into, but let's just first talk about the difference between cash and accrual. Now, cash-based accounting is basically where transactions are recorded when cash hits your bank account, okay? So let's say that you are the client and I send you an invoice, okay? And you take 2 weeks to pay me. That means that only once you pay me, let's say it's 2 weeks down the road, then that gets entered into our accounting system and gets recorded as revenue for our agency. So until you actually send me the money and the money hits my bank account, our accounting team will not record this transaction, right? Now that's cash-based accounting. So once the cash enters your bank account, that's when a transaction is recorded. Now accrual is really the complete opposite. It's very interesting. Transactions are recorded when you send an invoice, okay? So this means that the moment I send you an invoice, let's say I send you an invoice for $5,000 and it's gonna be for, I don't know, 1 month management. Well, the moment I send you that, our accounting team is recording that transaction as revenue, which is very interesting because I didn't actually receive any money. So even if you pay me like 2 weeks, 3 weeks, 4 weeks, 5 weeks down the road, from the moment I sent you that invoice, if you were to go into my QuickBooks, if you were to look at whatever, or our accounting, it would show that transactions, revenue, that you had already technically paid me, even though I definitely had not received that cash from you. So it's very interesting that you have these two different dynamics. And in an agency, it's really important because if you saw my previous video, this is part 2, by the way, this is part 2. So if you saw the previous video where I talked about the best agency billing system you can possibly use for your agency, it's important that you watch that before this, because now I'm going to get into this and how that ties into the last video. So first of all, the pros and cons of cash. Let's talk about that first. The pros of doing cash-based accounting is you have a great pulse on the lifeblood of your agency. What's the lifeblood? The lifeblood is the cash in the bank, right? You can't run the agency, you can't pay employees, you can't pay softwares, you can't pay anything, you can't pay your own office rent if you don't have cash. So that's the lifeblood, right? And this base kind of accounting system gives you a great understanding of how much cash is in the bank, right? Because it only records transactions when you receive cash. But the con is that it can get really damn confusing trying to calculate your true monthly P&L. Okay, now what is true monthly P&L? Well, if you saw the previous video I talked about, the chaotic billing system that most traditional agencies use, which I really don't like, is where, let's say I sign you as a client on the 15th of the month, and I'm going to give you PPC, Amazon PPC services or Google AdWords services or whatever it is. It's a monthly recurring type service. And my fee is $5,000 a month. I signed you on the 15th of this month, which means that I'm going to send you an invoice for $5,000. And on the 15th of every month, I'm going to send you an invoice for $5,000. Now that gets really complicated and complex when you have 100 clients all with invoice billing days on different days. It's terrible. It's completely chaotic. And if you're doing a cash-based accounting system with a chaotic billing system, it's an absolute nightmare trying to understand what your real profit and loss was for each individual month, okay? Why? Because if I send you an invoice on the 15th, okay, and you take 3 weeks to pay it, let's say I sent you an invoice, let's just say I sent you an invoice today. I think today's date is like December 6th or December 7th, and you don't pay me until January 2nd, okay? That means that the revenue is going to be recorded as revenue in the month of January. Now, when I saw this going on in our accounting system with our accounting team, I was like, whoa, 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 whoa. Why was our revenue and our profit so low last month? And why is it so high this month? We like there shouldn't be that drastic of a change. We only signed a few clients. And they said, oh, it's because, you know, Johnny, Jim, and Joe were all late to pay, and they paid at the next month. So this is where I was like, whoa, 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 fuck this. That I don't like that. Why don't I like that? Because first of all, it starts inflating and deflating your revenues, and you never know the true P&L. So it can get really confusing because clients will be late to pay, and then revenue will be recorded in a month where it shouldn't have been recorded. Now, technically, if you're doing a chaotic billing system, it kind of can be recorded in both months because the work that's done on the account is from the 15th of one month to the 15th of the next month, which is, again, why it's a chaotic billing system. Because if you're tracking your account executive's time, if you're tracking your VA's time on each individual client account, and you're trying to track your exact profit per account, it's near impossible to try and do that and understand your real profit on each individual client account when you have billing systems on the 1st, 3rd, 2nd, 7th, 9th, 14th, 21st, 30th. It's near impossible. So if you watch that previous video, what I talk about is a billing system where you bill on the 1st and the 3rd. Why is that so revolutionary? Why is that so damn important? Because we are only gonna bill our clients for 1 month, okay? And if we sign the client on the 15th of December, we're only gonna bill them a prorated amount for the remaining days in the month of December. Now, why do we do that? It's so that we can calculate true profit on each client account and understand our real P&L month to month, because I wanna know like month to month what it is. Because if I look at December this year and December next year, and I'm doing cash-based accounting with a chaotic billing system, I have no idea what my performance year over year is because it's a chaotic billing system. Maybe there was 40 clients that were late to pay. Maybe everybody paid on time, but last year they didn't. So you see what happens here. It gets really chaotic, which is why I was excited to make this video, because I was like, I can't believe there's so many agencies that are doing this. And really, you don't notice it until you scale your agency pretty far. I mean, this kind of becomes a problem when you have like 25 plus clients. So otherwise, 2, 3 clients, it doesn't matter if you do cash-based accounting, which is, again, this is why you should watch the other video, part 1, if you didn't, because it doesn't matter if you use cash or accrual when you only have 3 or 4 clients. When you have 25, 30, 40, 50 clients, 100 clients, this becomes a problem. So clients paying late with a chaotic billing system causes extreme confusion and really never allows you to understand your true P&L and your performance year over year, month to month, right? Now, with accrual-based accounting, it's interesting because what you can do is you can bill and record revenue the moment you send the invoice. And with the revolutionary billing system that I discussed in part 1 of the video last week, it makes a lot of sense because we're only billing for the month of whatever the month to date is, right? Any single client only gets billed for the month of whatever the month to date is. So transactions are recorded when you send an invoice. The pros of this means that it's great for clearly understanding your P&L for the month, because you know that, hey, we billed $100,000 this month. We sent out $100,000 worth of invoices, and that's what we're owed for the month of whatever it is, December. Great, okay, fantastic. Now, the cons to this is that you need to keep an eye on your cash, because if you just look at QuickBooks and you log in, and let's say, like, this is what happens to us this month, is we sent a ton of invoices on the 1st and the 3rd of the month, okay? And I log into QuickBooks, and the way that it works with accrual-based accounting is it's gonna show me that my revenues for the month are, the moment those invoices are sent out, my revenues are like $80,000, $100,000, whatever it is, and yet there's no actual cash that has come in, right? So the profit, obviously, like the net income, it won't necessarily be there because nobody has paid, and we've on the 7th of the month we pay employees. So if everyone's late to pay just 5 days, technically our agency will go down into the negative for like a few days if people are late to pay. But at the end of the month, most clients will pay. If you send the invoice on the 1st or the 3rd, most clients are all gonna pay within the same month. which is great because, again, it just allows you to be able to kind of better understand the P&L. So the only con to this is you really need to keep an eye on your cash flow, which I'm going to show you in this video. I'm probably going to dive into my computer like right now or maybe in like a minute, where I'm going to show you the actual spreadsheet that we use that shows not only the total revenue that's being billed, but the total profit and the cash that has been received and all that jazz, which you can still see in QuickBooks, but you kind of got to dig around and play around. So what's the consensus here? Well, the consensus here is that we use an accrual-based accounting method. Now, again, these aren't the only two differences. Accrual-based accounting method can really screw you over at the end of the year, if I'm not mistaken, because of taxes. Because if you bill like a huge amount of invoices end of year, close to the end of year where it's tax season, and the clients haven't paid you yet, I believe, and don't quote me on this, I'm not an accountant, I believe you do get taxed on that amount. So that's the one downside. I'm in Panama, there is no tax here, so I don't have to worry about that. So this is more beneficial. And you may want to double check with an accountant about what I just said, because again, I'm not an accountant, but I believe that's what our accounting team told me. And I said, okay, that's not a problem because we don't have to deal with that. So I prefer to use both, right? It's a combination of both. We use accrual-based accounting. That's what our accounting team does. But I have a sheet that shows me the cash flow and all that jazz. And so I can kind of see both worlds, all right? So with that being said, I'm going to dive into my computer with you. I'm going to show you kind of what the sheet looks like. I'm going to blur out some of the numbers, the P&L and all that stuff. But I'm going to show you kind of the hierarchy of what this sheet looks like. And it's a revolutionary P&L performance tracking sheet that does a whole lot more than profit and loss and all that. But all right, so let's dive into my computer and I'll walk you through this sheet that we created, okay?
All right, we are back in my laptop. So what you're seeing here is the Better AMS Performance dashboard. Now, this is basically the dashboard that we use for our agency to be able to track all the numbers related to our financials and the invoices that we send to each client, how much revenue one account executive is managing compared to the other, how much we're paying those account executives, what their commissions are, how many clients they've signed, how many clients they've lost, how many clients we've given them directly from the agency, and what percentage of our billings came through wire transfers versus credit card. Literally, you're seeing everything here. The amount of cash that gets held in reserve, because there's a 10% or 5% 6-month rolling reserve that our merchant account in Panama charges us for basically any processed payments through credit card. And then we know that, hey, for the month of December so far, 5% of the billings have gone through. 5% of the total like invoiced amounts have been paid, and the total amount of invoices that have been waived. So the actual amount that we've waived this month, because sometimes we have clients where performance isn't that great and we'll waive half the retainer, or maybe we'll keep a bit of the retainer. But anyways, the purpose of this dashboard is really to get an understanding of how much cash have we received this month, how much is still outstanding, and also basically, what is the overall performance of each account executive in our agency. So it gives an entire snapshot of the health and the pulse of our agency very quickly. And it allows me to know instantly which clients are late to pay, which clients have paid very quickly. You'll see here this average ARD. It hasn't quite calculated yet because it only calculates once all the clients have paid. But essentially what this average ARD is it tells you the average account receivable days. So basically how many days it took for on average for all of our clients to pay. Okay, so it's basically simple. It's just, if one client pays on the 5th, one on the 10th, one on the 13th, one 5 days late, one 10 days late, one 13 days, whatever. It'll calculate the average amount of days it took for all the clients to pay. We also see that it tells us how many clients we've signed, how many clients we've lost, our total amount of clients. Right now we're at about 29 clients. I think it should be 30. And our average retainer as well. Now the average retainer should be a weighted average, but it's not. So it's basically just a basic normal average. And then what we have is, like I said that earlier, paid percentage CC, paid percentage wire, or total amount of wire. Now, this is really important as well. This is one of our account executives. It's blurred out a little bit, but basically this is her total salary here, or total commission that we've paid out so far for this month, or the total amount that we owe her. This is the total amount that we've paid her. This is the total amount that we haven't paid. And you can see it's 0 and 0, and that's because it's the beginning of the month. We do our billings on the 1st and the 3rd. But it's a really important snapshot because it tells me how much cash we've received this month and how many new clients each account executive has signed or lost. And that is basically just an amazing thing to be able to see, because then you can kind of see and gauge the performance of each account executive. Now, what happens here is at the end of the year, I can be able to know how many clients each account executive signed, how many clients each account executive lost, and be able to know the margin on each account executive. Now, it's not an exact profit margin percentage because we're not per account, but we can know per all the accounts that they manage month to month, basically what their margin is, not factoring in, my salary or other expenses, but just the expenses associated with them managing the client account and successfully retaining them. So it's a great doc. And let me scroll down here a bit, and you'll also see that this is basically a different person, a different account executive in our agency that is managing also a lot of clients here. So a lot of this is going to be blurred out, but this doc, this sheet contains a lot of great information. So it contains the start date that we started working on the account. It contains whether we're billing them beginning of month or end of month. Now, again, if you watched my previous YouTube video, you'll know that there's BOM and EOM, and sometimes you have a hybrid where you're billing them up front and also a percentage of ad revenue or ad spend at the end of the month. So it's kind of a hybrid positive cash flow model with a little bit of fee on the end of month as well. And then you have the billing day. So everybody's either on the 1st or the 3rd. Payment contingencies are really important because sometimes we'll set performance targets that will impact how we bill our clients. And so you'll see that this particular client that we're looking at, the monthly management and optimization fee will be 6% of AMS ad revenue when the ACoS, this is like your ROAS basically, is less than 30%. And if it's between 30 to 35, our ad rev percentage will be 4%, etc. So there's basically thresholds, profit thresholds, that if we have this extremely profitable account, then hey, we get 6%. If it's between 30 to 45% profitability levels, we get 4%. If it's above 45%, that's terrible. We need to talk to the client and figure out what's going on, what's wrong basically. So these cells here basically tell us, when we sign a client, if it's their first month, we put yes in here, and that is basically what tells the indicator, the KPI overall performance dashboard that, hey, this is a new client. So there's a bunch of sheets that are interconnected here and cells that are interconnected. Then this is these 4 cells is what allows us to calculate the prorated fee. Because again, if you're going to use this 1st and 3rd of the month billing model, which really simplifies AR, you really need to bill on prorates, because if you're billing up front or you're billing end of month, again, to bill month to month, exactly month to month, it means that when you first start out with the client, that first month, unless you started on the 1st of the month, it's going to be a prorate, right? To prorate the month, basically. And then we have ASC or ISC. Now, this is something that we do internally in our agency. Basically, ASC stands for agency signed client. So if us as an agency, we bring in a client through our own lead gen methods, then great, that's an agency signed client. ISC stands for independently signed client, which is basically where if an account executive does his or her own lead gen methods and independently signs a client through their own lead gen efforts, then we track that as an ISC. The reason being is because we pay a higher commission to our account executives for the clients that they bring into the agency in-house themselves. And it's almost like they're building an agency within our agency. And that's why we kind of have that incentivization for them to sign their own clients. Now, that adds a lot of complexity. That one little thing, ASC, ISC, and we've been operating on this model for a few months now, and we're planning on maybe simplifying it and just having an overall structure where it's, hey, you just get commission on every account that you sign, but it starts off at a lower rate. We're planning on doing that to see how this pans out at scale, but so far it's been okay. Months retained, so you know how many months each client is retained. One of the things I see very few agencies doing is tracking the total amount of months that the client has been retained. Why is this important? Because you need to know what your LTV is. What is your LTV in an agency? It is how long you retain a client on average. So this dashboard, it goes month to month, okay, right? So you have October, November, December here in the bottom, and then you have a dashboard. I won't click on the dashboard because I don't want to blur a ton of stuff out, but it goes month to month, and it allows us to basically at the end of the year or at the end of the quarter, see how our average retainer increases or decreases, see how our retention rates and lifetime value has increased or decreased, and identify basically a whole different range of things. So really, this thing is not really a P&L sheet. It's a performance dashboard because it does so much more than just tracking your total cash or your total revenue. It also has the total commission percentage that the account executive is getting on the specific account, the date that they fully took over the account, because sometimes what you have is you have an account that's managed by one account executive that gets passed down to another account executive, and so that's what this cell here is for: the date we lost the client, the name of the account, the company name, the billing address, company address. This is all for the invoices, invoice purposes basically. And then we have the billing client's email, the description of the service. This here is just client billing information for the invoice, payment type, and let me scroll over here. I'm probably going to blur this out. And then we have a whole lot more stuff here. We basically have the setup fee if we charge them, setup fee, and ad rev retainer if we're charging them on ad rev. Account ad rev is basically how much revenue we drove for that specific account. This sheet tracks pretty much everything, and it's very important to basically track the health of our agency. So I recommend you use something like this. Am I going to share this right now? No, because I don't think it would be the best thing for me to share right now, just because I think that there's still a lot of work that can be done and I can still simplify. Now, it took me like a week to build this thing, but you can build your own model by basically looking at this and identifying, okay, hey, I want this, I want that, and I don't want any of that other stuff, because some of this may not apply to you. So I really recommend you build a dashboard like this. And what it allows you to do, this ties into the whiteboard, by the way, because it's technically, this gives us a pulse on cash, and also it gives us a pulse on accrual, because we can instantly see, how much has been invoiced, and also, how many, what percentage we've been paid for the month. It's an amazing thing, an amazing feeling to know that, within 7 days of the month, we've been paid 50% all invoices, or 70%, or whatever. And it's just like, at the end of the month, I can have peace of mind knowing by just logging to this sheet in 10 seconds and seeing that, okay, we have been paid 100% of all invoices that were sent out last month in November. And then, every single month, basically, at the end of the month, I'm looking at this sheet carefully to make sure everything's paid, etc. So it saves a ton of time for invoicing. It saves a ton of time for managing a shitload of clients. It saves a ton of time for understanding the performance of your account executives. It is a phenomenal sheet. I recommend you build something out like this. So this was part 2 of the YouTube video. Normally I end these videos off on the whiteboard, but for now I'm in my laptop. So if you enjoyed this video, if you found some value in it, hit that subscribe button below. And I hope you found some value in this piece. I post a video once every week. If you want help potentially scaling or automating your agency, again, you can hit up the description and you can check out my website. But right now I'm actually probably super busy. It's Q4, it's insane. So I probably can't help many people until like January-ish. But with that being said, hope you found some value. I'll see you next week on Monday. Thanks for watching this. Ciao.